Welcome to the Anton Stentner podcast. And today we're going to answer the question that people have been wanting the answer to for over 10 years. Why have home prices not crashed yet?
This is that one that like every consumer, why have they not crashed? When are they going to crash?
Even investors do.
Investors do. And the underlying tone is, I want them to crash. And then personally, Anton wants them to crash so he can buy things cheaper. So we all have, there's like this massive emotional undercurrent. And people want to know why it hasn't crashed yet. So we're going to go through why things have not crashed and possibly even a couple things that could cause it to crash. People think that when we started out with high rates, that high rates would cause it to crash because we saw a massive spike in rates. Let's look at history. In early 2020, the pandemic first hit, what did our Federal Reserve do?
Drop the rate.
Dropped it fast, dropped it aggressive. So all of a sudden, 30-year fixed debt gets to 3%. And then it even got into the upper twos in late 2020. So there's people with 30-year fixed debt that's like 2.75 today. Home sales in 2021 peaked at 6.12 million existing home sales. That is the highest level ever in the United States. Well, what was that fueled by? It was fueled by unbelievably low, cheap debt, the cheapest debt we've ever seen in our lifetime because of the ZIRP era. But then what happens? Because Jerome Powell turned on money printer, went brrr, and Congress was out there spending like drunken sailors, we get hit with that massive bout of inflation, brother. And as that inflation comes in, the Federal Reserve, they only have monetary policies. So they say, you know what, we got to jack up interest rates. They take interest rates from 0 to 5.5 on the Fed funds rate. The Fed's funds rate is the rate at which the Federal Reserve loans money to a bank overnight, and it affects everything else. What that did was that caused rates to go over 8% for mortgages by the end of 2023. And so that was the highest level of debt that the majority of consumers have seen in their lifetime. Because the last time interest rates were over 8% was in 2000, okay? So we haven't seen rates over 8 for 24 years. So the consumer goes, the world is ending. Prices have to drop. But they didn't. And so then rates peaked out earlier this year. We started out at about 6.6. We went up to 7.25 in May. And then what did the Federal Reserve do here in the last couple of weeks?
They started dropping the rates.
They started cutting the rates because the Federal Reserve has a dual mandate, which is to keep inflation at 2% and full employment. Inflation's been showing it's going down. However, unemployment numbers are rising. So now the Fed's shifting their viewpoint. Boom, they cut rates. And then what is your feeling, before we go into this next part, what's your feeling on, do you think we get a 1/4 point or a 1/2 point cut on the next cut right after the election? What do you think they're going to give us?
Oh, I am banking on 0.5.
Ooh,
but
0.5 again.
I believe it's going to be based off of the circumstances, which I think in the next 3 months, so we're talking October, November, and December, the economy seems a little volatile behind the scenes, and they probably know it. Secondly, election, right? And I think that whether you like to think that they're not like influenced by that, that could influence it, right? Because leadership could potentially change and like the tone or the direction. And the last one is what's going on in the world.
Yeah.
I mean, the war, I think wars sometimes do influence what the Fed does. So those three things happening right now, after we just jacked it up and they made this surprise move of 0.5, more likely that'd be 0.5, but am I ready to bet? I don't know.
So for those of you who are not regularly subscribed, there may or may not be bets that end up in the book over there, YouTube Secrets, that my main man Benji wrote here. Yes, we do make bets about real estate, and it goes into that book. I'm on the same page though. Today, it really feels like we're going to get another 50. We're going to get an aggressive cut because they're showing they're beating inflation. We're going to come back to this high interest rate thing because I want to talk about high interest rates and affordability and then tie the two of these together. If you want to go look at rates, go look at the Federal Reserve's on the St. Louis Fed. You can see the 30-year rate charted out since the 70s. The next people go, and this is probably the next thing I hear. This is number 2. Everything is so unaffordable, prices have to come down. Emotionally, spiritually, psychologically, I agree with the buyers and the investors. Everything's so unaffordable, it has to come down. Unfortunately, one of the things we're going to get into later, we're going to talk about supply and demand and how demand is exceeding supply. But unaffordability today, you're at the second most unaffordable time since the 1980s. So basically, in 40 years, this is the second most unaffordable it's been. So when the consumer says it feels unaffordable, it's because it freaking is. This is unaffordable. The other time was basically in the late 70s, rates were in the 8 to the 9% range. Inflation, boom, popped up. Sounds pretty familiar. They thought they had it beat. They didn't. Inflation, boom, pops up again, now in the 80s, in the early 80s. Paul Volcker steps up and did what no one thought he was going to do. No one thought he had the guts to do. He jacks interest rates up so high in order to squish inflation because we're having the gas crisis, the Cold War, and inflation's just going out of control. We're worried about the Soviets. There's a lot of, tension. Sounds kind of familiar. So there's a lot of tension going on. Do you know how high rates got in 1981?
I think 22%.
So some of them did for some people, guaranteed. When you go and look at the Fed's chart, almost 19% in 1981.
Like the difference between 19 and 22 is like whatever.
Yeah, whatever.
After 10, it's like, it's crazy high. That's nuts.
So that was actually the most unaffordable time in history. And then realize today you're at the second most unaffordable. So when that consumer says, I'm feeling pinched, they actually are. It's very real. But when we go and now we bring these together and we look at interest rates and we look at affordability and we look at inflation. And I want you to ask yourself the question, do rates make it so I have to have price reductions? In other words, does a massive increase in interest rates cause price reductions? Well, let's go look at history. So if we go back and look starting in 1970, and I'm going to just read off some rates for us real quick. 1970, the average mortgage rate was 7.33, 71, 7.38, 72, 7.38. Oh, now we're going up. 73, 8, 74, 9. Inflation's 11%. Okay. So if you think inflation got bad now, go talk to mom, dad, go talk to grandma, grandpa, and ask them about the mid 70s and the early 80s. Rates are now 75, 9%, almost 9% in 76, almost 9% in 77, 9.6 in 78, 79, a great year, a good vintage. That's the year I was born. Rates go to 11.2, but wait, inflation is 11.25. Okay? Here comes my main man, Paul Volcker. Inflation's 13.55% in 1980 when I'm 1 year old. Interest rates go to 13.74. 1981, mortgage rates go to 16.63. But the question that I want you to be asking yourself is, what happened to home prices? Only in 1982, and we've got 1970 to 1985 sitting right in front of me. Only in 1982 did they go down for a moment in time. And we ended the year up 0.5% with 16% interest rates. So when I ask you, do rates affect home prices? The answer is yes, they affect purchasing power. Yes, they affect demand. But when rates were over 16%, they didn't cause home prices to fall.
That's crazy.
It blows my mind.
I didn't know. I've never looked at the home price compared to the rates. You only know the rates were really high, and you just assumed, oh, no one's buying. There's probably like tons of people trying to sell or whatever. And look, it's literally it's going up in all those years. I don't even see the blip that you're talking about.
Well, I did dig into the data, and I only gave you the table version. But in the beginning, basically at the end of 81 and the beginning of 82, prices did go down, and then they finished the year slightly up. And what's funny, when you look at this range, Benji, the range is literally 0.6 to a high of 13% over that high inflationary time. And so our recency bias, when we look at the great financial crisis, says all prices have to go down during a recession. But when inflation was worse than it was today, with higher interest rates, we saw price appreciation. Then it has to be due to a massive decline in demand. What if demand went down significantly, Anton? What if there was less demand? Well, let's go look at demand. In 1970, the average price of a home here in the U.S. was $23,400. Who listening to this would like to go back to 1970 and buy a home? I mean, you could put
everybody. It's like how much my car costs.
You could put a home on a credit card. So we sold 2 million homes in 1970, and your average interest rate was 7.33, and your inflation rate was 5.8. Now let's go forward in time. Let's go to 1979, that good vintage year again. Inflation's 11%. We sold 3.1 million homes. Interesting. So during that whole time period, while inflation was rising, while interest rates were rising, because interest rates were 11%, we sold more homes. But then it does dip down because inflation gets so high and because rates got so high. So then basically from 1979 to 1981, we go from 3.1 million units sold in existing home sale to 2.1. So we lose 1 million home sales. So demand drops by about 33% when interest rates go from 11 to 16. But what we just talked about was we didn't lose home prices due to the lack of demand. Well, let's go look at today. So we know the Fed goosed us. Okay, so we had COVID. We know rates got really cheap, and then the Fed goosed us. So let's look going into COVID. So going into COVID in 2018, you sold 5.3 million homes. 2019, 5.3 million. 2020, 5.6. The Fed juices us in 2020, and you go to 6.12 million in 2021, aka the highest number of existing home sales ever. In 2022, the Fed raises rates dramatically to combat inflation. So once again, this is that killing of demand. We lose almost 1 million home sales. We drop to 5 million. 2023, we drop to 4.16 million. And this year, according to the National Association of Realtors, I just looked this up, our run rate right now is 3.86 million home sales. So home sales have gone down more this time than they did during the 70s and 80s. Okay, so they had higher rates, but we have less home sales. Now remember, population did significantly go up. Also, the price of the home went significantly up. So the average price of a home in 2024 is $421,000 versus, like we talked about, in 1970 it was $23,000.
Based on demand and the historical examples, the most realistic thing that would happen is that home price growth just slows.
And that's all we saw happen.
That was at 20, like you said, almost 20% interest rates.
And almost 20% interest rates. So history is repeating itself right in front of our eyes. In history, it's not always the same, but it definitely rhymes. So we're just looking at the pattern, okay? We're cautiously optimistic. And we know the Fed has started cutting rates, and we know that mortgage applications are up over the last 2 weeks as rates have gone down, because rates are about 6.15 today. So therefore, if you're a betting man and you want to put money in that there book over there, do you believe we'll sell more than 4 million homes in 2025?
Probably.
Yeah, exactly.
At least the same amount.
At least the same amount. Now, I want to throw one more thing out here for perspective. 4 million homes, or hold on, let's get the real number. 3.86 million homes is lower than what we sold in 2009, 10, and 11, and 8. So we're selling less homes today than we did during the great financial crisis when we saw massive price drops. Interesting. Well, let's dig into more data so we can explain to everyone why home prices have not gone down. Well, it must be due to recessions. I mean, you agree, it's got to be because of a recession. Home prices have to go down in a recession, don't they? Tell me in the comments if you think it has to go down in a recession. The short answer is no, it doesn't. In the early 20th century, from the 1900s to the 1940s, home prices were actually way less volatile because the homes were very small and there was less fluctuations in the real estate market. But during the recessions prior to the 1940s, there was very little decline, if any, in real estate. Well, let's look at post-World War II recessions. They were the same. All of those recessions were relatively stable, and they experienced no to small or moderate declines. We talked about the 1980s and the 81-82 recession, where home prices grew by 6.1% during the 1980 recession and 3.5% between 81 and 82. And like I said, at the beginning of 81, that was that just barely year. Well, what about in the early 90s? In the early 90s, same thing. Flat for a moment in time, up. Well, what about the dot-com recession in 2001? Home prices grew by 6.6 during the dot-com recession. See, this is the one that gets us, though. Our recency bias of the great financial crisis says because in the great financial crisis, prices went down, that logic fallacy in our brain says now all prices have to go down in recessions. What we forget was the great financial crisis was caused by real estate. It was caused by banks putting together creative mortgages to get people into homes that shouldn't have gotten to homes, where we lied about their credit availability, we lied about their ability to repay it, and then they lied about the packaging of the debt and said the debt was A-plus paper. Go watch the movie The Big Short, or go read the book. You'll get more about this. But from peak to trough, we saw a 30% drop in home prices nationally, while still selling more homes than we are today. Well, what about the beginning of COVID? In the beginning of COVID, we did see mild price drops. Then the Fed dramatically lowered rates. And as they dramatically lowered rates, we saw prices increase. So what's the pattern that you're seeing here, brother man?
There's two of them. Well, let's talk about the lower interest rates. Well, during one of the drops in prices, a COVID one, the interest rates dropped, prices go up.
Yes.
What are we in right now? Interest rate dropping season. Okay, so that's like a consistency there. And the second thing I've never thought about until you really described all of this, the thing that made the Great Recession unique in connection with home prices, the thing about that season that was different than all seasons, including right now in relation to home buying, is at the speed at which somebody gets qualified and can buy a home. It was freaking crazy. I remember, you could have no kind of history.
Yes.
You could have never bought a house. And I mean, tell me, think back to those times. If someone came walking into your office, I'm not saying you were the only one doing this or you did do this, but just hypothetically,
yes.
How quickly from the moment someone hey, I want to buy a house to the point where they're in the house, what was average record speeds?
Well, I mean, record speeds was less than 2 weeks. No joke.
Okay, let's just think about this. Let's say 2 to 4 weeks.
Yeah.
4 weeks is still kind of crazy. That never happens now.
No.
There's a way longer process because regulation came in.
Yes.
The mortgage industry got their ish together, right?
Yeah.
And think about this. Because it's so close in our memory, the professionals have better practices.
Bingo.
And then even us, right, as buyers and sellers, at least the ones that live through this, we're a little more careful about it, right? Maybe this is one of the reasons like, oh, the crash is happening because it's so ingrained. So have you ever thought about that? The speed at which you could get qualified and buy a house not only is one of the reasons why all these other times you didn't have that, because it takes longer and there's more check boxes to mark off. But during that time, that was directly correlated to the triggering of the crash, because the crash was bad debt.
It's like, okay, let's break this down for the listener so they're on the same page.
Yeah, because you might have gone through a little loop-de-loop in your brain.
No. I want to get very clear about like multiple factors. We created financial engineering instruments that allowed buyers to qualify faster with more debt and more risk, while not documenting their income and financial situations. So what we did is today they've got to save up. They have to improve their credit. So we took crappy buyers from the future who would have normally had to improve their credit, improve their down payment, improve their financial positions. We took people who were not yet ready and qualified, and we shoved them into homes with artificial demand. And we called them ninja loans, the no income, no job, no documentation, liar loans. And if you could fog a mirror in 2003, 4, 5, and 6, you got a loan. If you had a pulse, you got a loan. If you were out of bankruptcy, and yes, we did do this, shortly out of bankruptcy. Right now, it's like 2 years. You could be shortly out of bankruptcy. They would give you a loan. There was a subprime crisis that happened. So we took these fake buyers, we made them into real buyers, and we created artificial demand. So that artificially shoved up prices with buyers that never qualified. Then what happened was those buyers that didn't qualify started getting behind. The economy started changing. Unemployment rose, expenses rose, and the cost of debt rose. So their credit card payments went up, their auto payments went up, their student loan payments went up, and their mortgages, which were on ARMs, reset to higher debt rates. So this tsunami of debt for people who didn't qualify came to roost. Well, guess what? That was 30, 40% of the people, because we cheated. They weren't ready. So we lost them all at once. And the foreclosure rate it peaked out at almost 10%. That's the highest rate ever. All of that washed out, all in one giant swath. That's why it hurt so bad. Because we borrowed all these buyers from the future who should have qualified over the next 3 years.
And that's why the crash happened. But why isn't it happening now?
Because they have to freaking qualify. Because of Dodd-Frank, okay? Because of all this consumer protection stuff. They verify the income today. They verify the deposits. They have the down payments. They have better jobs. Unemployment is so much lower. But yes, we do have higher credit card debt. And yes, we do have higher student loan debt. Those are problems. That is becoming a problem. Like if I was to say what could cause prices to crash, commercial debt, student loan debt, credit card debt.
But to a certain degree, banks are accounting for that like 100x more than literally they don't give a ish about it back then.
I want to go into one of the other points.
Yeah.
One of the other points is literally the banking system. So let's go through that right now.
Okay, cool. Let's go.
The banking system in the great financial crisis and prior to this, it had no mercy. It was just a process that was executed. And what happened was there was such a deluge during the great financial crisis, whole departments were put together and policy and procedure was put together by banks to deal with foreclosure. Then during COVID, they got smarter again and better again. Because what they did during COVID was when everyone got behind and the world got laid off and everyone was told to go home, what did banks do? Did they foreclose on anyone?
In 2008.
No, in 2020 during COVID.
They didn't, because, well, I don't know why, but they didn't compared to the recession.
Correct. So during COVID, we hit an all-time low in foreclosures. I think it was 0.06 was the number. 0.06% were being foreclosed on, the lowest ever, because the government put pressure on the banks and said, don't foreclose on people. And the banks then looked down at their balance sheet and realized, man, if we just delay this process and slow it down, most of these people are going to catch up. Most of them have equity. So the whole foreclosure process has actually changed since the great financial crisis, where a bank is giving the homeowner longer. So that's preventing foreclosures from coming in. That's preventing this oversupply. So we got an oversupply because, remember, let's say 30% of the buyers should have never purchased. That created over demand. When they got foreclosed on, that created oversupply. Today's foreclosure rate is 0.26. The lowest recorded rate, which was in 2021, is 0.11. So half of what it was today. The peak foreclosure rate in 2010 was 2.23. So for prices to drop because of foreclosures, the level of foreclosures would have to 10x where it is today to get to that same level. In 2007, 8, 9, and 10, what did people not have? They didn't have equity. We have the largest amount of equity in our homes today. If people were to get behind, all they have to do is sell them, and they can pocket cash instead of going into foreclosure. That's why foreclosures are so low. So two things is happening. You're not getting the oversupply from foreclosures to drop prices. Number one. Number two, banks fundamentally changed their foreclosure process and are being just plain more lenient and slow about it. They're slowing it down. They don't want to mark down their balance sheets. They are having to deal with the commercial problem. So they're worried and focused on that and just basically ignoring the residential problem, which is essentially almost non-existent today.
It's like they're putting consumers in more debt and extending any of the negatives. If not, maybe that never come around. It just means that more money is going to the banks versus your own bank account.
They are milking it from the consumers. I mean, so
that's pretty crazy. That's wild.
It's really crazy. Okay. What could cause prices to drop significantly? A massive change in consumer confidence. So this is what's interesting. Our economy is a consumer-based economy. The consumer spends, we have money. Consumer confidence over the last 30 days has actually gone up slightly, even with the economy showing signs of not improving, of getting worse, and unemployment rising. Consumer confidence is pretty good. Consumer spending is slightly up, but it is becoming a bifurcated market. Let me explain what I mean. The bottom part of the middle class, so let's say the middle of the middle and below, is spending less. The middle and above is spending more. So it's becoming the tale of two markets. And we've talked about this on other podcast episodes, and we have other videos about this. It's that idea of the K-shaped recovery. It's those that have assets are continuing to grow during this economy, and those without are getting hit harder. Why? Inflation, taxes, insurance, cost of groceries. So if the consumer doesn't feel some reprieve, and this is why I believe more Fed rate cuts are coming, and I'm willing to make bets on them, and I am betting my own money other than just against you in the purchasing of more real estate right now. You can catch us at resg.com, because I believe and know that the Federal Reserve is on the path of lowering rates, which is increasing demand. And as credit card debt gets cheaper, as auto loan debt gets cheaper, as business lines of credit gets cheaper, the economy will slowly start to speed back up. So Jerome Powell, I'm in the maybe soft landing camp right now. 45 days ago, 60 days ago, pre-rate cut, I was in the, hey, we're heading towards a hard landing camp. and based on the totality of the data and how things are moving and playing out in front of us. So I'm very cautiously optimistic about our economy, but we do have to prevent the consumer from going into the doom loop. And we have to prevent massive layoffs from happening, because what happens is you can see this in the stock market right now. You can see the stock market where earnings are coming in less and revenue is decreasing, which means because your labor cost is one of your highest expenses, right, for a business. So they're now starting to look at their labor. But, Coca-Cola doesn't want to lay someone off because they're worried that, well, then those good people might move over to Pepsi. But if Coca-Cola starts to lay someone off and then Pepsi's earnings are slightly down too, well, then they might lay someone off also. So realize this is a cycle that if it starts, and this is why the Federal Reserve started cutting rates, that corporate America starts a wave of layoffs and it becomes a self-fulfilling loop. This one is still a problem. We're not fully out of the woods with the consumer confidence, doom loop, unemployment.
This is why the Federal Reserve, the government, banks can't let another 2008 happen, because the most doom and gloom situation is losing your home, is seeing your neighbors go into foreclosure, is because, it's the number one asset people have in their life. Yeah. It's more than an asset. It's literally your home. So to be homeless, even if you go into renting, it's so devastating. That's going to put you into literally like a mental depression. And that's what they're trying to avoid. So it's interesting. Like you said, think about all the patterns, the things that I'm recognizing right now. Avoiding foreclosure.
Yes.
Or extending the foreclosure process to give more opportunities to like alleviate it or fix it. Lowering the interest rates, right, when they need to, aggressively. That's always been the case. They always drop it lower, right? Faster? Or do they raise it faster?
So the answer is it depends, but you are correct. So generally speaking, one of their first cuts is a big cut, and they usually go 1 to 3 good-sized cuts and then slow down.
Yeah. So what I'm saying is real estate being at least healthy or just steady might secretly be one of the most important things the Fed and the government keeps an eye on. Yes. But they just don't mention it, right? Yes. They don't want anything to get sparked up.
No. They do mention it. Okay, so remember, we're data nerds here. We're looking at these things for our listeners and paying attention. Yeah. What's the Fed's favorite metric?
For
inflation.
The core
PCE.
Yeah.
Okay.
Which includes housing?
No, that's X housing.
Okay.
But they use PCE, but they love core. Well, what does PCE include? Housing. And how do they weight PCE and CPI? Like 40% of those metrics is based on housing. So over a third of how we measure inflation inside the economy is strictly based on housing. So they're sometimes going to pretend it's not important. They know it's vitally important.
That's what I'm saying. They pretend it. They don't. They almost like brush over it. But yeah, that's my thing. And that's why. And it's like you want to talk about data in any given average American's life, like the real estate, the mortgage, the rent is the biggest financial factor.
It's a huge, consistent monthly financial expense, and it's one of our basic human needs. So it has to always be taken into massive consideration. What could cause prices to drop dramatically? A massive change in population. So I went and looked at population. Holy cow, our population's growing pretty good right now. So
people had babies during COVID.
People had babies during COVID, and honestly, we turned back on immigration too. Okay. We need to fix part of our immigration and have a good immigration policy. That's a different story, and we need to close the border. But as of September 25th, there was 337,166,737 people here in the United States. This data is coming from the census.gov/popclock. You can go and find this. We have a birth here in the United States every 8 seconds. We have a death every 11 seconds. We have an international migrant net every 27 seconds. So we have a net gain of one person in the U.S. every 15 seconds. So just since we started talking about this little thing, like 6 people moved into the United States. I want to play one of our games, bro. Don't look at the next page.
Okay.
What states have the highest population?
The highest population?
Highest population.
Oh, California.
California, 38.96 million. Which one's next?
Next one would probably be Texas.
Texas, 30.5 million. Who's next?
Okay. I feel like I'm in school again.
Yeah.
Next would be, I want to say New York.
Oh, so close. Florida, 22.6.
Okay, that would have been
And
my
then New
other
York
one.
is next.
Oh yeah, Florida and New York. That's right.
Yeah.
Are they pretty close though?
Yeah, New York's 19.57, Pennsylvania 12.3.
But Florida, what is New York and Florida?
Florida is 22.6.
Yeah, so pretty close.
Super close. Okay. This next one blew my mind. So we know it's in California. What county has the largest population in the U.S. and then which and we'll get to why we're talking about population, but realize population is important for pricing. So which county has the highest population in California and how big is their population?
Oh, I mean, I would assume it's L.A. County.
Yeah.
Yeah. And what is their population?
Yeah.
I want to say 12 million.
Almost 10, 9.66. Dude, I didn't realize 10 million people live
Isn't that
in
what
LA.
in Washington is like? That's our whole population.
That's the whole state.
yeah.
Cook County, Illinois, 5 million. Harris County, Texas, 4.8. Maricopa County, Arizona, 4.58. That's where the Phoenix Valley is.
So what's your point though with saying these big counties?
Where large populations are, prices are the most stable. So one thing to be thinking about it, because there are places across the U.S. where there are some prices going down. Remember, we're talking about nationally right now.
Yeah.
There are some areas where some prices are going down, but nationally it's going up. So as a real estate investor, as a consumer, you can protect yourself when you're buying in a high population area, in a job growth area, in a growing population area. I want our consumers to be paying attention. If they're moving to somewhere and the population is declining, prices might go down there.
So maybe rent for a little bit.
Bingo. San Diego, 3.3. Orange County, 3.1. Miami-Dade, 2.7. Okay. Now let's look over at cities, and we'll finish off the Jeopardy round. What city has the highest population? How many millions?
Okay, well, it's probably Los Angeles, or
That's number 2.
that's number 2. Okay.
New York,
Oh yeah, duh.
8.3.
Yeah, million. Yeah.
Yeah. And then just in the city of LA is 3.8 million. Chicago, 2.6. Houston, 2.3. Phoenix, Arizona, once again, in Maricopa, like we had talked about, 1.65. Philadelphia, 1.55. San Antonio, 1.5. San Diego. So what's interesting is you're seeing the usual suspects: California, Texas. And what I want people thinking about when they're purchasing is I just literally want you to go into Google. I want you to pull population data. I want you to figure out if the area you're looking to purchase in is growing. The Seattle metro, where we live and sell real estate and where the majority of our metro or investing happens, our population is growing because we have good jobs. We got great weather. We got a great, climate, good economy. Politics, plus or minus, depending on your side of the fence. But our area is growing, so I feel very comfortable investing here. We have very stable prices. King County, which is where Seattle is up over 10% year to date. Snohomish County is up over 6% year to date. That's the county right north of it. Why? Population. Okay. So last but not least in our examples, and this is one of the most important ones, inventory. During the great financial crisis, what happened was builders and developers could no longer afford to be a builder or a developer, and the banks shut them down. Just like the consumer was getting massive credit extended to them going into the great financial crisis, the builder and the developer was getting massive credit extended to them. So they were able to finance at 100% loan to value and sometimes even more. Today, the builder developer is 75% loan to cost. That means the average builder and developer has 25 to 35% more cash into building homes today. So what are they doing? They're building larger homes. We're building less homes. Why? Because we got to get back to a profit margin that works. It's not even just because they're greedy. It's just strictly they have to be able to maintain some type of a profit margin. And so going into the great financial crisis, we built 14 million homes from 2000 to 2009. It then plummeted to 7 million homes from 2010 to 2019 as a result of the Great Recession and the Great Financial Crisis. So that number dropped by 7 million homes over the next 10 years because of that cash requirement. Estimates show that we are between 1.5 million to 6.5 million units behind on housing right now. That's all housing. That's duplexes, triplexes, fourplexes, single families, townhomes, and apartments. Zillow estimates we're 4.5 million units behind. So what happened was, even as homes became the second most unaffordable in history, as inflation's destroyed our pocketbook and pinched us at the gas pump over groceries, in taxes, in insurance, and I'm talking about property taxes specifically, and homes became the second most affordable since basically 1979, 80, 81, 82. This is why prices haven't gone down, because we're so far behind on housing. The demand, even though we were selling less homes over the last couple of years than we were during the great financial crisis, the demand for those homes was so high because we built 7 million less between 2010 and 2019. This is why prices haven't dropped significantly. This is my crescendo.
Okay, so I have two thoughts. One question and then really a theory. Why are banks and just people that control money requiring builders to have so much more cash in it compared to in 2010 when they were 100% financed?
I want to answer that question with an example. There were 600 local community banks in Washington state prior to the great financial crisis. That number today, and I don't have the exact number, is now somewhere in the 200s. So we lost 300-400 banks because they became financially insolvent because they were lending money out to builders and developers who they had over-leveraged credit to. It was just dumb. That was bad financial sense. It was brought on by the drunkenness, by the everyone's doing it, so everyone just kept extending credit. They shouldn't have done that.
So you're saying they shouldn't be doing it even now, the
They
100%.
should not be doing it even now.
Okay, then my second statement is my theory. If housing is so important, could you say that the government and the Federal Reserve potentially is controlling and influencing the way they are getting financed through like the back channels telling these banks, because they're all just getting bigger, right? There's less banks, there's just bigger banks.
Yes.
And they're like, hey, we can never, ever let supply get out of hand. Because if it does, right? So they're not saying this to the builders, they're saying it to the people financing the builders. Because if supply gets out of control again, then you potentially have price drops.
Yes.
Then you have that, like you said, the doom and gloom loop
Yeah.
where people start panic selling, right? Before it gets really bad, like what they did. That's interesting to me because you and I, like for the last 2 years, we're like, why aren't we just taking off the red tape? That red tape is part of like suppressing the
Yes.
building of homes.
The red tape suppresses the supply, which artificially keeps up the price, which artificially keeps up our consumer economy. But what has the government done during this whole time? They've just spent more money. So the government has to artificially keep up the price of homes so we all spend more money and pay more taxes so they can afford their own freaking debt. Second, politicians are bought, and they are bought by contributors. Do you maybe believe that hedge funds maybe contribute to politicians so that things maybe get voted a certain way so they can maybe buy a ton of properties and make trillions of dollars on real estate?
Definitely.
So I'm not trying to be the conspiracy theorist here. And yet the deep state is forcing housing to stay artificially higher and more expensive because it keeps the economy moving. And we have to do that because they're blowing $1 trillion every 90 days.
And it keeps paying the government taxes.
And it keeps paying the government. I'm hoping, so I am hopeful, and I also spend my own money here, fighting back on a local basis through local political action committees that I'm a part of to cut the red tape, to provide attainable home ownership to people. I believe in and support a super strong middle class. That's the bedrock of our society. And we've got to get politicians to limit themselves and to limit the campaign contributions and to stop spending so much so we can have a stable society. That's what a lot of this is about. In summary, man, prices are not falling because we haven't built enough homes. Foreclosures are basically at an all-time low. Banks have figured out they do not want to foreclose. They will just simply delay it. Demand is much higher than the supply. Unemployment is still very low. The economy is still growing very well. The GDP estimate for Q2 was like 3.4%. So the economy is still growing. And now debt's getting cheaper because the Federal Reserve has started lowering rates and they're on cycle and they're still restrictive. And that means the Fed still has room to pinch things down, which means all debt's going to get cheaper, which means housing gets cheaper, but credit cards and student loans and cars and lines of credit for business. So the economy will slowly start to stimulate itself out of this. I don't see how prices drop in front of us today. Could that change in 6 months? Absolutely. And because of all these factors, home prices are just going to continue to go up from here. I mean, they have to keep going up. Could something change? So what we want you to do is every time you're looking at this and you're trying to figure out, is this something I should be doing? Reach out to us at resg.com, 425-249-0214. Let's have a discussion, get into the specifics here in the Seattle Metro. What's happening with that neighborhood? What's happening with that type of real estate? What's happening with that price point? Because there's always deals, there's always opportunity, and things are always moving, but you got to make sure you're looking at it. And if you're looking somewhere else in the country, we know other gangster real estate agents and investors who can help you all throughout the country. So always just reach out to us because there's always opportunity. In closing, we want to keep watching and want to keep paying attention to the totality of the data, just like Jerome Powell says. His line's cheesy, but it's true, to see where things are going. Right now, I'm in a maybe soft landing. I'm slightly bullish, And I'm very long-term bullish on housing due to this lack of supply. Very long-term bullish. And I want people to go take advantage of that lack of supply, that 7 million homes less that we built between 2010 and 2019. That's their opportunity.